Welcome to the Daily Update. This is Being Prepared Wednesday, July 20th, where we'll look at the action in the market today and then see how things look for Thursday, July 21st. And right off the bat, you're probably going to hear some background noise. That's due to construction that's going on all around where I'm at right now, and it's getting closer than it was before. Also, I'm in a different room because of the noise, and I kept waiting for the noise to die down, and just about the time I think it's okay, that's when it picks up again. So I just have to power through this if I'm going to get the video posted in a timely manner. So I apologize ahead of time. But hey, I didn't do a video yesterday, and we had a really strong up day, and we had a follow-through day. What do you know? Yes, our charts are starting to look more positive. A lot of charts that I took out of the video after Monday's session, they're now back in the video because some of our scenarios are looking a lot more positive now. So let's go back and talk about what happened. Right at the open, we had a flat to slightly negative open, but then some buying quickly came in and took us up to R1 at 39.64. Then as the day went on, prices did retreat and they came almost back down to the unchanged level, which in this case acted as a support level. But then as the day went on, buying came back in again, and that was pretty positive. We could have just continued to go lower after having such a strong up day the day before, but buying them brought prices back up to R1 again at 39.64, right around that level. Going into the close, we closed near the high, and not a real strong day, but just the fact that we were up. We were up strong one day, and then to be up 0.59% the next day, we haven't seen that in a while. And we're seeing a lot of continuation of the buying in growth. Volume was below average, and I think we just kind of have to get used to that. Of course, if it stays below average, that moving average is going to decline, and eventually it will come down to the average. The technicals are showing a lot of improvement right now, but the big question is, can it continue? Are we just seeing a dead cat bounce? Now, we have a lot of charts that suggest that no, we're not. We're seeing the beginning of what could be a strong move, but we've seen that before in 2022, only to have it fizzle out and defy what we're looking at and go back and set an even lower low. So we have to be careful. But you have a lot of people that just don't think the market's going to go up from here. Just look at the front of your YouTube page. Market's going to crash. Yes, we're bouncing, but it's getting set to go even lower. All these doom and gloom things, and they may be right. But when everybody's singing the same song, that's when we look to change the tune. That goes back to my musician type of thing, a way of looking at things. But the big fixation continues to be inflation and interest rates, which is producing growth concerns economically as well as within companies. We have a lot of geopolitical concerns, and they're not necessarily getting any better, but they're not necessarily at the forefront either of what's going on in the stock market. They may be going towards the forefront of your life and what you're worried about and what you're fixated on yourself, but this just shows that the stock market tends to look at different things from time to time. We have earnings season that's starting to come out now, and we're seeing some big companies with their earnings reports. And then the recession fears, the battle that goes back and forth, the debate. Are we in a recession now? Are we going to go into a recession? Are we going to not go into a recession? And there's cases for either side. And I have some additional Isabel Net charts because I didn't do a video yesterday that I'll show you. And some of that deals with being in a recession. So we saw the second up day in a row, and we had pretty solid gains. And we're seeing a real improvement with our charts. The sector rotation, that's still looking pretty good right now. Growth performed really well over the last few days and really strong. The 10 to the 2 and the 10 to the 5, they still remain inverted with the yield curves. And we're watching the 10 to the 3 month. Fear is starting to decrease. It's giving up a little bit, and I'll show you that. We had existing home sales that came out, and they were down 5.4% on a month over month basis. Our trend, our ADX is still below 20. So we are non-trending right now, but our bias, since we've had 2 up days now, I'm switching it back to positive. Our momentum, I'm still saying, is mixed. We want to see more than what we've seen. We're starting to get back into some moving averages now. Can we break above those moving averages, or will they act as resistance? So let's go back and talk about today's session. We really came up out of the fear. We're at 39 right now. So we're starting to bounce up a little bit, where we had been way down below 25 for a lot of 2022. Here's some Isabel Nut charts, and they talk about where's Lehman. That's supposed to be funny somehow, but it's just a net percent taking higher than normal risk levels. When it's above this line, that means people, they're okay with taking on more risk. When we drop down, that means they're not willing to take more risk, and we're starting to get back to the low that we saw at the lows in 2008. So this could be used as a contrary indicator. When everybody is all freaked out and they're out of riskier investments, a lot of times that's when the smart money comes in and starts to buy. Here is the US dollar index, which has been seeing a little weakness. Now, if we do get set to go higher with the S&P and all the other indexes, we're probably going to see the dollar come down. So I don't know where you come out as far as having a strong or a weak dollar. The official stance of the US government is that we have a strong dollar. The unofficial stance is we have a weak dollar, but lately it's been pretty strong. But here's the dark blue line showing how the dollar's been going up. And then this is the 3-month, 10-month real US. That real just takes into account inflation, the treasury yield curve, and it's advanced 12 months. So this is one of those shifted charts. And it just shows here, if you go by this, that the dollar could still continue to go higher. Interesting. We've looked at other charts that suggest the dollar could go lower. This is the Morgan Stanley look at the recession probability. And this goes back to 2000 when we had a recession. And what was this chart doing at that time? And then here is 2008 when we ran into some trouble. Here's the COVID, the very short recession that we were in. And we're still going up now, but we're not necessarily at this line. The proverbial red line for recession inevitability. There, I didn't say that right. Inevitability. When we get above this line, that means there's going to be a recession. Well, we're not there yet. This is the CPI annualized. So you take whatever it comes out every month and then magically turn it into a 12-month return. This is annualized. The 6-month CPI change is the highest since March of 1981. Yes, yes, yes. That's when I was getting ready to graduate high school, by the way. And this just shows how the CPI is very high, and we haven't been at this high level for a long time. But look at how things are different. In some ways, they're the same, but in other ways, they're different. So to compare this to other time frames, yeah, it's rhyming, but it's not necessarily telling the same story. Here's the US share buyback authorization. This could be positive. This just shows that companies may go in and start buying back their own stock. And it hasn't been this high in a long time. So now it doesn't mean they're going to buy. It just means that they've announced that they might buy. So they made an announcement about this. And then these are the cash levels as of July 2022. It just shows that a lot of people are in cash right now, which tends to be a pretty good thing because the dollar is what's been doing the best. Here are credit risks. They're really high right now as of July. And this is the SoftBank 5-year CDS, the CDs. So it just shows that we're at a pretty high level right now. This is put out by Bank of America. And then here's the gap earnings and forward estimates. So this is looking back as well as looking forward. And what are we going to do? Are we going to have to lower the EPS estimates? There's still, and I've been talking about that in other videos, where we're still showing that they're lowering estimates, but not necessarily across the board and not necessarily far out from now. Are they going to have to come back and lower these estimates, which could really take the market lower? Here's the aggregate US equity futures and the ISM manufacturing, which is an important economic report. And it just shows, here's the ISM, that's the green, and it's been declining. And here is the equity futures. They've been really going down too. So these two tend to move along hand in hand with each other. This is just showing that when it's most of the dots or the diamonds are on the left, that means most folks are in a risk off position, meaning they're out of the stock market, they're into bonds, they're into things that are considered to be less risky. Here is the high and sticky inflation. They're saying that that's the biggest risk of all right now if inflation stays high. That's what people are thinking. And this is put out by Bank of America. So they're just saying as of July, this was what people are most worried about. And that's why I have it as a bullet point, where in June, not as many people were worried about it. So inflation's really sticking up its head. You have all the other things that folks can worry about: global recession, the hawkish central banks raising interest rates, different credit events that may happen, Russia, Ukraine. See how that's gone down now. Something could easily happen in that conflict, and that could go back to number one. And then civil unrest. Should that be civil unrest? I'm not sure what civil unrest is. And then that COVID-19 is going to come back. You still have a few people that are worried about that, and they're still dealing with that in China as well. This is how investors are looking. Is the economy going to be stronger in the future? No, not right now. But see how they're getting to really extreme levels? This is oftentimes when things can change. These are the risky versus safe assets, just showing that we're well below being in risky assets right now, which means stocks. And then this is, are we going to go into a recession? It's really peeking its head up, but it's not as high as it's been before, but it's still high. Then this is the earnings estimates that are well ahead of economic realities. This just shows how a lot of the estimates that are coming out are really suggesting that they're unrealistic right now. Then this is saying, what should you be in right now? The most crowded trade. Most people are in cash right now. They're long the US dollar. There are futures contracts and things on the dollar that you can get into, but a lot of everyday investors are probably just in cash. They're also getting into energy, but they're starting to get out of that now because they got burned just about the time that became the cool thing to do. That's when it hit its top and started to come back down. Now it could go back up, but people really get burned in those kind of things. All right, then we have inflation being the key driver of the Fed pivot. They've told us that already. So US inflation, where the PCE, that's different than the CBI, it drops below 4%, that's when they think the Fed will pivot at that point. And we're well above that right now. Then here is looking at privately owned housing that have been authorized by permit issuing places. This tends to really fall off when we go into a recession. Yes, it is declining, but is it falling as drastically as what we've seen before? This is a screenshot. This is part of what I look at while the market's open. And I used to not really pay attention to this until I saw that sector rotation thing starting to happen. This shows that even on an up day, the value, they were down 0.08%. And I really watched the large cap growth and the large cap value. I don't pay as much of attention to the core. These are more the cyclical things. They go up when the economy's going up. They go down when the economy's going down. But the real battle that we're seeing is between value and growth. So I've been really watching this, even on down days. And this might be down, but it's down less than the value. And that just shows that the rotation is continuing. I look at the mid caps and the small caps, but since we deal with the S&P 500, this top line is what I pay attention to the most. All right, we have our national financial conditions, the weekly update. It is still climbing, but we're still below the black line. The GDP now is updated, showing, and this is the one from the Atlanta Fed, showing that we are going to be negative. I think this is Atlanta. I can't tell sometimes. All right, here's the VIX, where we've been really going up with the S&P, so we're going down with the VIX. And we're also seeing the VIX of the VIX showing a decline over the past couple of days. We're seeing bull bear ratio. We don't get the individual investors until Friday. but it's coming down a little bit. Some folks are starting to get more into the bullish funds and getting out of the bearish funds. The Ulcer Index, this is the daily chart, but this is, I brought up the weekly chart this time. This is more indicative of what we've been seeing, where we saw an awful lot of fear and now we're coming back down from that. We're down 17.82% from the all-time high. The equity put call ratio actually went up a little bit. I'm keeping an eye on the VIX because it's that little extra weird chart. It's starting to act up, but not enough for me to necessarily bring it up yet. And here's the 5-day, which shows that we're decreasing in the equity put call ratio. This is the interesting thing too. On Friday, July 8th, there was a 92% chance that the Fed was going to raise 75 basis points. Then, as of the 14th, it was back down to 50-50. This is where we're at as of the last reading. We're at about 66, almost 67% chance that they're going back to the idea of it being a 75 basis point move. All right, support and resistance, and I've taken a lot of the crazy charts out. Here are the support and resistance levels on the intraday chart for Thursday's session. Here's the daily chart showing how we're breaking above the pivot point. And this is looking pretty good so far. We have some resistance. Now, if we can get back to this gap area and somehow try to fill that, that would be very positive for the S&P. So that's kind of the area that I'm watching right now. It's about the 4,000 level up to about 40 or so. And you can see on the bottom where we're dropping off in volume. Here's the daily chart showing that we're coming back up to this resistance level, which could be big. If we can break through that and get into this gap area, that would be quite positive. And I have to clear my throat. Sorry, that was a cough. Here we're breaking above these fib levels. They've been holding up okay. We've dropped down below them a time or two, but right now we're starting to go above them, but we have some pretty significant resistance above where we're at right now. Here's the sectors showing that communication and discretionary and tech were all up over 1%. The ones that were down over 1% were just the utilities. They've been showing some improvement lately. Well, on Wednesday, they didn't. Here's the scooter ratings where you have the energy sector is the only one in the 90s right now. And we have communication, which is the weakest, and it's just under 20. Here's the sectors going back to the all-time high with energy being positive. Now utilities and all of the other sectors are negative. Here are the indexes going back to the all-time high. Not much has really changed yet. We're seeing a little bit of the percentages taken off when we have up days, but if we have down days, the percentages get added back to this. Technical alerts, they were pretty positive. For the S&P, we went above 50 with the BPI, and I'll have a chart to show you there. No other S&P signals, but we did have oil go below 100. Here's the intraday chart where I can kind of go back over the 2 days where we really gapped up higher on Tuesday and then just took off and closed right about at the high on Tuesday. That was very positive. Typically what we've seen is a down day. And after having a little bit of trouble at the beginning, we did get up to R1. We danced above R1, but then we broke down almost back down to the unchanged level. This is where things could have fallen apart, but they didn't. Buyers came in and took us back up to R1 again, and we closed near the high. Here's the trend showing the ADX is still below 20, and the green line is just a little bit on top. So we have just a slight positive slant to the ADX. Now, if these lines can get far apart from each other, the ADX will then turn back up. Here's the Arun. Man, it really shot up. It finally saw something that it liked, and it shot up saying that buyers are in full control right now, and our oscillator has shot positive as well. Breadth showing improvement based on price and volume. The advanced decline ratio above 0 and advancing, so that could be positive, but we might have overdone it. There's a couple of charts showing that we're going up a little too far, too fast, and I'll show you those. New highs, new lows, also showing improvement. Accumulation distribution, also looking more positive. Short term, we're above the 20. What do we know about that? My goodness, and well above it. In fact, we're up to the 50 now. Here's the rate of change 5 period. We're getting a little topsy in the short term, just going back over 5 periods. So we might have overdone it just a little bit, but we could still go higher with this indicator. Here's something you haven't seen in a while. Here is the short-term rainbow chart where we've broken above all of the moving averages there. Here's our moving average tree showing that now we're battling the 50-period moving averages. We haven't seen those in a long time. Stochc RSI looking a little extreme positive. Williams percent R also extreme positive. Force index, not necessarily extreme, but showing some improvement. Swinland trading oscillator, positive based on price and volume. McClellan oscillator still has a little bit room to run, but is turning positive. Our 20, 50, and 200-day moving averages are really showing some improvement. Stochastic looking a little topsy in the short term, has a little more room to run in the intermediate term, and long term has finally turned up. Here's some intermediate term charts. Here's the 50-period moving average. We're above the exponential and simple moving averages. Here's the PMO looking positive and it's turned back positive based on price and volume. Our PMO steady looking a little topsy with those that are rising. The buy signal starting to get a little topsy, and those that are above zero is advancing. Chaikin oscillator advancing. Chaikin money flow coming down just a little bit because we finished near the high. I don't know. This is just a strange indicator. It's positive for right now. Volume, because we're seeing a real shift into lower volume, it looks like it might be improving, at least on a measurement basis for right now. The vortex is now positive and the green line is slightly above zero. The summation index based on price and volume is advancing, and we actually saw volume lead this a little bit. That could be positive. Seeing a little bit of a mixed picture with our oscillators. The slope is still slightly negative, but we have the MACD, KST, TRIX, PMO, and the TSI. They're all positive now. So a little bit of a mixed picture here. Here's the BPI above 50. Ease of movement, looking positive. Ultimate oscillator, also looking positive. Here's the intermediate term rainbow. Haven't seen this in a very long time. We're coming up to the underside of the 50. Can we get up to the 60, which is kind of where we're at right now? But then we have a 70, 80, 90, and 100-day moving average for intermediate term. The CCI 14 periods looking a little topsy now, and the 20 period also. Money flow index is still looking positive. We're up to the underside of the itchy cloud. We haven't seen this chart in a very long time either. This could act as resistance. And of course, if we go up, then we have other areas that could act as resistance as well. Bollinger Bands showing that we went up a little too far, too fast. We're getting to the upper band right now with the %B indicator. The TTM squeeze is still looking more positive. It was kind of going back and forth there for a while, but with the pale lines that are blue, that's a little more positive. Here's our different charts. Heikin-Ashi looking more positive. The Kegi switched back to black. That is positive. Renko has not redrawn, but is still looking positive. Here's the 3-line break. We added some new boxes here that weren't there just a couple days ago. The point and figure chart, we do have it's like a double top breakout kind of a thing, kind of a reverse dance here. We had another X drawn. This could be showing a breakout right now. Our different trading systems, the elders for the SPX is positive, and for the SPY is positive. The SAR switch back to positive. That's one of the reasons I wanted to do a video yesterday, but I couldn't. I just couldn't do a video because the dots have now come underneath. So this just switched back to positive. We're still more in neutral with the go, no go system with the neutral purple. Long-term charts, we're still coming up into the underside of the rainbow. We have a long ways to go, but we're showing improvement with the 50, 150, and 200. The special K, still pretty much flat. These are longer-term indicators that take a long time to switch. The diamonds coming up to this moving average here. It's a 65-period moving average. Will that act as resistance? But the diamonds are positive. Here's the Dow where we broke above the 50-period moving average. So that's looking a lot better. The Qs also just a little above this moving average and looking more positive. Here's the NASDAQ 100 coming above the moving average. Now we have R1 above where we're at right now. The Vixen is showing a bit of a decline as we're going higher. The NASDAQ also has R1 above, and we're looking to the NASDAQ for leadership. If it starts having some trouble, we might pull back a little bit. If it continues to show some strength, we might have the ability to break through some of these resistance areas. The mid caps also are looking a lot better right now, and I have the small caps to show you later. The Wilshire broader based index also showing some improvement. Here's some other areas. The dollar, it was up a little bit after having a really difficult day when we had that strong up day on Tuesday. Gold still having an awful lot of trouble, as is silver. And the S&P to the dollar, they're now going in opposite directions. They're in a pretty significant opposite direction look right now. So if the dollar's going down, that can help stocks go up and vice versa. Oil is below 100. The S&P to the oil correlation, they're still kind of headed in the same direction, but it's weakening a little bit. Looking at bonds, not really a big improvement based on price. They were down a little bit. And the world bonds, they were down a little bit as well. And maybe they're building some kind of a base here. Then here's our yield curves, where we have the 10 to the 5 is still negative. We have the 10 to the 2, that's the one that people really watch, that's still negative, and the 10 to the 3 month. And I also have the 30 to the 5, which I forgot to put a chart on here, but that doesn't seem to be a real big deal. But we're keeping an eye on this one here, the 10 to the 3 month. Here's the tech sector to the 10-year yield. They're still kind of going in the same direction, even though it wore off a little bit. Here are the yields just all over the place, crossing each other, going every which way right now. Our scenarios, we're still coming up of those stocks that are above their 200-day moving average on a percent basis. We hit an extreme negative and we're still trying to bounce up out of that. And if you look back at other times, this often marked a low in the S&P. The 10-day moving average of the highs and lows, after giving an extreme negative reading, we're starting to bounce back up. Also, if you look, this often marked a low or near a low in the S&P. Here are the stocks above their 50-period moving average, extreme negative and bouncing up. Here are the mid caps, extreme negative, bouncing up, and that highlights in the wrong place. Same with the small caps. They're looking better, but the highlight's in the wrong place. Here's our equity put call ratio, 5-period moving average, longer term chart. We spiked up and we are continuing to come down right now. Other times this marked a low. So we're seeing another convergence with multiple signals now. Here's our small cap index, really showing some improvement. And we're seeing a real spike up in the ratio between it and the S&P. And this is helping us out a little bit. We're seeing a little bit of a spike up. Sometimes 1 or 2 or 3 days later, we can see a move up in the S&P, which is the blue line here. The S&P to the 10-year yield, they're kind of going in the same direction right now. 10 to the 2-year, I'm sorry, S&P to the 2-year. I don't know what I'm saying there, but they're kind of still going in the same direction. The market's still trying to figure out what it wants to do. The Copic curve, it was almost coming back down and taking that signal away. Well, with the last couple of up days, it's turned up as well. Our bottom fisher is still giving us a signal. Here are the sector rotations. The Qs are going up against the S&P. Discretionaries going up against the S&P. Large cap growth is advancing against large cap value. And here's the large cap again. Mid caps are advancing and small caps are advancing. So this is still hanging in there. The staples, we're getting really close to a death cross still. See how we're kind of bunched up right here? Yeah. But this is interesting. This is a valid signal, it looks like. See how we've really come down in the staples to S&P 500 ratio? It really spiked down over the last 2 days. This could be a top. So, and which is often marked a significant low in the S&P. So what's our outlook then? The technicals, they're really improving right now. Sentiment is getting a little more positive. The economic reports, we have jobless claims that they come out every week, and we have the leading economic indicators. We have the whole list of geopolitical events, but inflation and interest rates, that's still what the markets are focused on. But any one of these could come to the forefront at any time. All right, so we're not really going down right now because the ADX is negative for all the reasons that were on the previous slide. The technicals are improving. And we're not really going up yet because the ADX is below 20, but we're showing a lot of improvement and a real disbelief that we are going to go higher. And our possible positive scenarios are still hanging in there. We have some positive setups. We have some things that could suggest that the S&P is going to have a nice run up from here, but we always have to be respectful of price. In our technicals, we're getting back to some moving averages now. And sideways until we get back above 20 with the ADX, we have to be more neutral in that regard. At least I am. You might be more aggressive, and I should have switched that to positive because the green line just barely went over the red line. So our conclusion is we're improving, but can it continue in the short term, in the intermediate term? Long term, we're still negative until we get back to the 200-day simple moving average. So thank you. Have a wonderful Thursday. We'll see how things play out. My anticipation is to make a video for Friday's session, so I'll probably talk to you then.